Hey traders, I just want to talk to you about a potential opportunity on Kiwi dollar. We have a bearish pin bar reversal testing this horizontal level at 0.7609. It's a classic test of old support, as you can see here, tested all the way back in December and once again in January this year, having been broken and tested with this bearish pin bar reversal. And what is interesting about this one as well is that it correlates with the 0.618 Fibonacci retracement level as well, so that's a useful correlation, not to mention also the 50 moving average. So we've got good evidence in support of a potential short. The only thing really against it is this shallow retracing cyclicity making higher highs and higher lows. However, one more thing in support of it is this bearish reversal divergence. If we take a look here, we've got a higher high made on the price action, where we've got a lower high made, the RSI, crossing the overbought zone to the midpoint. And this signals to us that the strength in the bulls, as reflected with this bearish pin bar reversal, is getting more diminished. So how can we play this? If you like the look of it, then you are blessed with two options. What we can do is simply take the classic trade where we trade the break of the low, place our orders at the low of today being Thursday, minus spread, minus the pip, with the stop loss above the high, plus spread, plus the pip, and trade it for every second seller bar, and anticipate that we've got it going to make a new swing low. We've just got this horizontal level here in the way really, but as far as the shorter term cyclicity goes, we do have this to break as well. If you wanted to be slightly more aggressive and trade it according to our advanced pin bar strategy, then what you can do is simply what we call 50 Fibit, and that means essentially putting your order for a short halfway up the bar or at the 0.382 level with your stop loss above the high. This means that if there is retracement to the upside, you can get a much better fill up here or even up here, but the market might not let you do that. The market might just go down, straight down, and not for you at the midpoint. That is the dilemma as traders we're faced with. Do we want a more aggressive entry and more potential reward to risk? Please bear in mind that the initial original entry, taking the break of the low of stop loss above the high, is a decent 3-to-1, in excess of a 3-to-1 if it does play. However, if it goes and just crashes on Friday, tomorrow, and it doesn't retrace the 50 fib level, then you could be out of a winning trade. So it's really up to you. How do you want to play this? I mean, one way to get the best of both worlds essentially is to cut whatever you risk on this trade in half. Say if you risk 1%, then potentially what you could do is risk 0.5% on the original pin bar reversal strategy, i.e. putting 0.5% on the trade which has your entry just below the low, minus spread minus a pip, with your stop loss above the high, plus spread plus a pip, and the second portion of your trade at the 50 fib level with your stop above the high plus an extra pip. So you've got three options, depending on whether you are a conservative trader, a more aggressive trader, or if you want the best of both worlds. And only take it if you like the look of the setup. I mean, we've got technical reasons in support of a short, based on our best understanding of the market here. We've got, just once again to recap, old support becoming new resistance. We've got bearish reversal divergence. We've got a bearish pin bar reversal, but we do not have a lower high on the shorter term cyclicity. However, at that point, we've still got enough in favor of a short. Okay, so that is Kiwi dollar.